let me just extend my own welcome to all of you. This is going to be an excellent panel. We have a wonderful set of speakers who have been tasked with an almost impossible thing, which is to provide you all with a clear set of background facts, which turn out to be kind of problematic these days, and their insights into the economic and political status of global trade relations. I want to say that this area of trade policy making is probably the one thing that needs the least introduction, in that it has appeared regularly on the front of every newspaper since the Trump administration. I just want to point out it's one of the areas in which there is the most misinformation about what is going on in the world, and the one in which I think that for those of us who study politics and the economics of trade, an area in which policy and what we think are our priors are most out of line. It's been a very interesting, heady time for us, those of us who study this stuff, because every morning we wake up and we're shocked at what has happened in Washington. We are going to begin this panel with Alan Sykes, and each of the members of the panel have been asked to do something different. We are going to go from the most general to the most specific. So Alan Sykes is going to begin, and we have asked him to provide us with background and context. He will then be followed by Susan Lund, who will give us a deeper understanding of the market forces and how they are affected by the institutional structures that Alan will describe for us. In particular, she will help us understand supply chains and the how and why of the challenges being faced today by corporations worldwide. Finally, Tamara Lundgren will take us even deeper into one case, that of steel. As you all well know, this is the steel producers and the production profile holds a critical place in the American economy. It has been at the center of President Trump's use of tariffs. It is one of the most interesting case studies that we could have chosen to present to you today. I'm going to give you short introductions on each of these three speakers who all have very long and very excellent backgrounds, and then each in turn will recognize the next. Let me begin with Alan. Alan Sykes is a leading expert on the application of economics to legal problems. His writing and teaching has encompassed a variety of topics, from international trade to torts to contracts to insurance to antitrust to international investment policy. 2010, he founded the Stanford Law School program in International Economic Law, Business, and Policy. He is a member of the Executive Committee and the Board of the American Law and Economics Association. He's an associate editor of the Journal of International Law, a member of the Board of Editors of the World Trade Review, a member of the editorial board of the American Journal of International Law. Before joining the Stanford Law School faculty in 2015, actually, he was here in 2005 to 2012 and then left and came back. He was at the law school at NYU, and prior to that, in 2005, he was at the University of Chicago. Alan holds a PhD NJD from Yale University. Susan Lund is a partner at McKinsey Company and a leader of the McKinsey Global Institute. She holds a PhD in applied economics from Stanford and a BA in economics from Northwestern. Her research focuses on global trade, financial markets, the impact of new technologies on all these areas. Dr. Lund is a trusted advisor to CEOs and other executives at global Fortune 500 companies. She's a frequent speaker at global conferences. As well, she has authored numerous articles in leading business publications, including the Harvard Business Review, the Financial Times, the Wall Street Journal, Washington Post, Foreign Affairs. She is currently on the Economic Advisory Board of the International Financial Corporation and a board member of the National Association of Business Economics. Tamara Lundgren is the president and chief executive officer of Schnitzer Steel Industries, Inc. SSI is one of the largest publicly traded manufacturers and exporters of recycled metals in North America, operating 100 facilities throughout North America. SSI's vertically integrated operating platform also includes its steel manufacturing business, with manufacturers which manufactures finished steel products used in infrastructure and commercial projects. She joined SSI in 2005 as the Chief Strategy Officer and thereafter held increasingly responsible positions. Prior to SSI, Ms. Lundgren was a managing director at J.P. Morgan Chase and the Deutsche Bank and was a partner in the Washington, D.C. law firm of Hogan Lovells. Ms. Lundgren has also served as President Obama and reappointed by Trump to the Advisory Committee on Trade Policy and Negotiations. She has earned a BA degree at Wellesley and a JD at Northwestern University of Law. I'm going to begin by calling Al up. Al is going to begin by giving us a general background of the institutional structures in which the current trade policies are operating. And from Al, we will then go and pass on to the firm, and from the firm to a particular industry. I'm sure you'll have questions. The slides are excellent. I've seen the slides. And hopefully we will have time at the end in order to elicit questions from you, and you can get answers from this very esteemed panel. Let me begin with Al. Thank you.
Okay. Well, thanks, Judy, and thanks to Mark for asking me to participate. It's a pleasure to be here. As Judy indicated, my task is to sort of set the table, give you some background on the role of international trade in the U.S. economy, the concerns about it that have been bubbling to the surface in recent years, policy changes in response to those concerns, developments in the Trump administration, where we've been, how we got to where we are today, where we're going, and some of the fundamental questions that exist for the future. So I'll start with just a little bit of perspective on international trade for the U.S. economy. The 2018 numbers came out 2 days after I sent my slides in, but I have the 2017 numbers here for you, and I'll mention a few things about the 2018 numbers as I go along. Exports, 12% of U.S. GDP, imports at 15%. We've had a trade deficit every year since 1974. You can see from the slide, $550 billion was the 2017 deficit. It rose to $621 billion based on the initial 2018 numbers. We are, despite those rather large-sounding numbers, we're less dependent on trade than some other countries. Germany, for example, exports something like 40+% of its GDP. As you can see from the next little chart, this will give you some sense of who our major trading partners are. Our biggest export markets are Canada and Mexico. Our biggest source of imports is China. China is also a big export market for us, but the gap, you'll notice in the first line of this slide, is quite large, a $336 billion bilateral trade deficit, which accounts for roughly 3/5 of the total U.S. Trade deficit. And we have deficits with a lot of other countries too, although they're vastly smaller than our trade deficit with China. If you took Econ 101 and remember any of it, you might recall that a trade deficit is also those numbers, by the way, were the trade numbers for both goods and services, not just merchandise trade. So those were the current account numbers, as economists say. We learned in Economics 101 that the current account deficit will always be roughly equal to the capital account surplus, which means that when we're buying more goods and services from abroad, we are going to be leaving them with some excess revenue that they're not going to paper their walls with, but they're going to use it for something productive, like buying stocks and bonds and real estate and so forth. So we are exporting capital assets to them when we are running a trade deficit. That's why we call it a capital account surplus. But another way to think about that is, as we run a trade deficit, we are in some sense borrowing from abroad to finance that trade deficit. And so that's what you see in this chart here, a steadily increasing net international investment position of the United States that reflects that we're selling more capital assets to foreign buyers than we are buying abroad. And so that's a nice segue into what's going on with the conversation about trade in the country these days. Just as background, I assume most of you know that U.S. trade policy has been subject to an enormous amount of international negotiation down through the decades, going way back to the Roosevelt administration. We are subject to numerous agreements, the biggest agreement being that of the WTO, which superseded the General Agreement on Tariffs and Trade, the GATT. But we have a bunch of free trade agreements as well with about 20 countries now. And the conventional economic wisdom about all of these trade agreements has been fairly favorable. That is to say, the trade liberalization that these agreements bring tends to raise national income, tends to increase global output, grow the pie. Everybody can potentially have a larger slice. There's been some debate about the bilateral and minilateral agreements that introduce some trade discrimination into the global trading system. But by and large, the conventional wisdom is that these agreements are good for economic growth and prosperity. That said, everyone acknowledges, and has for a long time, that the effects of trade liberalization are not uniform across individuals or industries. There are winners and losers, and we are not necessarily very good at redistributing the gains to make sure that there aren't some significant losers in the end. And I'll just mention one very prominent study, probably the most cited article in recent years in international economics by Autour et al., which studied the effect of the entry of China into the WTO and drew the conclusion that China's entry into the WTO has resulted in the loss of something like 1 million manufacturing jobs in the United States during the first decade of the 21st century. So that sort of issue has been a concern. And then we have the growing trade deficit that I mentioned in these earlier slides. That has become an issue. Now, trade deficits, an economist, isn't going to worry terribly much per se about trade deficits usually. There are many things going on, many moving parts. It has to do with economic growth here relative to the rest of the world. That's the prevailing explanation for the growth in the trade deficit in 2018, where the US economy was doing relatively well. Trade deficits depend on fiscal policy. If we run large government deficits, we have to borrow from the rest of the world if we don't want to see interest rates shooting up to help finance those. We have a relatively low national savings rate, which means we need to borrow from abroad. And so all of those moving parts go into the capital account surplus and accordingly the trade deficit. But for better or worse, political leaders have, in both parties by the way, have seized on the accumulating steady trade deficits as indicators that these trade agreements that I mentioned a moment ago are bad deals, that they're unfair to the United States, that they are undermining our prosperity, and that has a lot of political traction, whatever you think about the pros and cons of the economics. And that in turn has led to a lot of developments, along with the China issue and the other things I mentioned before, a lot of developments in US trade policy. And so now let me turn to the issue of where we are today, how did we get here, where have we been, and where are we going? So just a tiny bit of history. In the 1930s, there were big tariff wars. You might have heard of the Smoot-Hawley tariff and the retaliation that followed it. In the Roosevelt administration, we realized that that was an economic mistake. We began to negotiate trade agreements to bring that down. And at the end of World War II, we decided that we needed to go multilateral. And we went and formed the General Agreement on Tariffs and Trade, which was designed to be a multilateral institution that would include all the major trading nations eventually. And a cornerstone principle was non-discrimination. We would treat everybody the same. Interestingly, the United States was the prime moving force in pushing for non-discrimination. We had felt discriminated against prior to the GATT, and we wanted this multilateral system in which everyone would be treated the same, no tariff discrimination, and that was enshrined in Article 1 of the GATT, called the Most Favored Nation Principle. And that system grew steadily to today's WTO, with 164 members and 23 observer countries that are sort of in the process of joining, essentially all the players in the world, part of this multilateral system. The other part of this system that was key was a move away from threats, unilateral tariffs to try and get your way, counter-retaliation, escalating trade wars. That was the experience of the 30s. The idea was to move away from this sort of unilateralism and try to build a system that was rules-based, where if we had a dispute, if we thought we were being treated unfairly, we'd go to court instead of having a trade war. And so over time, the GATT, as it evolved into the WTO, became more and more detailed in terms of the treaty text, which now fills 500 pages, something like that. It's an extremely detailed treaty system. And the goal was to have a system where if disputes came up, we would go to court. You had a right to an arbitration panel. You had a right to appeal the results of the arbitration. The rulings would ultimately be legally binding. So that's sort of the post-war paradigm as it evolved. But unfortunately, that became subject to a number of difficulties that predate the Trump administration and even the Obama administration. The system became increasingly unwieldy, 164 members. Changes have to come by consensus, where everyone accepts the change. Hard to get 164 countries to agree, needless to say. And so the last major negotiating round of the WTO collapsed as a failure. It was called the Doha round, started in the 90s. And secondly, we had increasing dissatisfaction with this rules-based dispute settlement system because countries started to feel that the court was engaged in judicial activism, a complaint that we hear about domestic courts too. And the United States in particular became concerned about judicial activism in the context of certain treaty obligations relating to anti-dumping. And so that was growing. And then because of the stasis in the negotiation process, we had this proliferation of bilateral, minilateral, NAFTA type agreements that were reintroducing into the system the very discrimination that the GATT had been founded to try and get rid of. So then we come to the Obama administration. And how did they react to these developments? The Obama administration focus was on the stasis of the WTO and the alternative of the mega-regional option, the Trans-Pacific Partnership to encompass a dozen countries or so, the Transatlantic Trade and Investment Partnership, that was seen as a bulwark against China. And the Obama administration was quite dissatisfied with a number of WTO rulings, and they started blocking the appointment of appellate body judges, which are necessary to resolve disputes. Then came the 2016 election cycle, where we had criticism of the Trans-Pacific Partnership bubbling to the top of the debates in the election cycle. Why was it the TPP? It was because it was an unratified agreement and people didn't have to worry about its actual effects. They could talk about its predicted effects. Even though it was largely modeled on NAFTA, it became subject to withering criticism from both the left and the right. And a big target of criticism turned out to be the investor rights provisions, which were said by folks on both sides of the aisle, whether it was Donald Trump or Bernie Sanders or even eventually Hillary Clinton, that these investor rights provisions gave investors the ability to receive compensation for the effects of reasonable regulatory changes, and that this, by the way, only applied to foreign investors, not domestic investors. And this was an impediment to reasonable regulation, created all sorts of regulatory chill and the focus and the like. And then there was an increasing focus also on China. As these studies came out showing the effects of China on the US economy, the Chinese bilateral trade deficit with us was growing rapidly. We felt we didn't have good market access to China. We'd lost jobs, and intellectual property issues were bubbling to the surface as well in our relationship with China. So that brings me to the Trump administration. What's going on today? The Trump administration began almost on day one by saying, we're getting out of the Trans-Pacific Partnership. We're going to scuttle that deal. It then went forward without us as the CPTPP. Soon after the Trump administration took power, after some sort of minor things involving tariffs on washing machines and solar cells, the president invoked a kind of little-known provision of the Trade Expansion Act of 1962, which concerns import restrictions to protect national security. An investigation was done by the Commerce Department, which found that steel and aluminum imports threaten national security, and the result was 25% tariffs on most steel imports and 10% tariffs on lots of aluminum imports. Another investigation has recently been concluded that the administration is sitting on automobiles and automobile parts as to whether those imports threaten national security. One conjectures, though I haven't seen the findings, that the investigation provides the president with the legal basis to impose auto tariffs and auto parts tariffs should he choose to do so down the road. What else has happened? We have renegotiated the U.S.-Korea Free Trade Agreement. That renegotiation has already led to an agreement that has been implemented. No congressional vote was needed. There was nothing that required statutory change. Probably the most significant development in that agreement renegotiation was the replacement of the steel tariff on Korean imports into the United States with a voluntary, quote-unquote, voluntary quota imposed by the Korean government on its exports to reduce its exports to 70% of what they used to be. The other big ticket item, I think, probably was the extension long-term of the tariff on SUVs from Korea, which was supposed to go away pursuant to the FTA. Secondly, we've renegotiated NAFTA. We've come up with a new agreement called the USMCA, US-Mexico-Canada Agreement. That has to be approved by Congress. It has not been voted on yet. Two of the most prominent parts of that agreement renegotiation involve restricted eligibility for duty-free treatment in the auto sector. There has to be more North American content in cars to get the benefits of duty-free treatment. And we greatly watered down the investor rights provisions so that, for example, US investors can no longer sue the government of Canada, Canadian investors can no longer sue the government of the United States, and our rights in Mexico have been diminished. Next major development, there's a provision in the 1974 Trade Act to allow the United States to take action against practices that are not illegal under international law, that don't violate any commitments to us, but that we unilaterally deem to be unreasonable and to burden or restrict US commerce. And this is what we've used to go after some Chinese practices, such as some of the practices that are referred to as forced technology transfer. An example being, if you want to invest in certain Chinese advanced technology industries, you must have a joint venture with a Chinese entity, and that gives that venture leverage to negotiate technology transfer, or perhaps simply the opportunity to observe the technology and learn about it that way. We've declared those to be unreasonable practices, and on the basis of that declaration, we have imposed hefty tariffs of 10 to 25% on $250 billion of Chinese imports, with a threat of more currently suspended as negotiations with China continue. So, just to summarize what's been going on with the Trump administration, a clear preference for the bilateral approach versus the multilateral approach or the mega-regional approach of the TPP. A lot of focus on steel and autos in the Trump administration, not terribly surprising given the 2016 election cycle and the states that were critical to the president's success. We have some ongoing use of the WTO for disputes. We filed some cases against China, for example, but we've continued to refuse to approve judges for the WTO, and we are almost at the point, just a few months away, when there won't be enough judges to decide cases at all, so that the dispute system will completely grind to a halt, and there will be no longer an option to go to court. It simply won't be functional. And the other thing that we see in the Trump administration is a willingness to just sort of say, whatever we agreed to in the past, we don't like it, and we're not going to abide by it. So we agreed that we would do very limited national security measures in the GATT, but we've declared steel imports a threat to national security, even though US steel domestic production is 30 times greater than annual consumption of steel by the Department of Defense. The tariffs we've imposed on China violate our WTO tariff commitments to China. The Korean steel quota violates a provision in the WTO safeguards agreement that was supposed to put an end to these so-called voluntary restraint agreements by foreign governments. And so that leaves me with my last slide, which I'll call the fundamental questions that are pending. Are we at an inflection point? Is this the end of the post-war paradigm that's built on multilateralism and rules-based adjudication? And I have colleagues at other institutions that are already writing papers to that effect. The end is near, we're never going to go back, we're returning to the days of pre-GATT, or at least before the WTO came along with its appellate body system. will we, in effect, then return to the power-based diplomacy of threat and counter-threat that we saw in the 30s and in the lead-up to GATT? Or will we kind of go back to normal with the multilateral structure of the WTO humming along in the background, and then incremental progress being made in the form of smaller agreements that are easier to reach given the burdensome consensus requirement in the WTO? And the final question is the Trump administration aberrational? Or will we see a continued push on the part of whoever comes next to cut back on the U.S. involvement in the international trading system? Certainly, there are voices on the left that are just as critical of the traditional order as the Trump administration. So that's where we've been, where we are, and the questions that I have about where we're going. And let me now stop and turn the baton over to Susan Lund.
Thank you. That was fascinating. I'm going to turn to what companies are doing. So I'm a leader, as was said, of the McKinsey Global Institute. We are the economics research arm of the global consulting firm. In our most recent work, we looked at what's happening within 23 different industry value chains. So there's a big misconception that trade is a simple affair where bananas are grown in one country and they're shipped to a different country. As it turns out, 2/3 of world trade today is an intermediate good, and that means it's a part that's sent on to the next producer, value is added to it, another producer, their subassembly, and finally you get these finished goods. So as a result, the trade flows that we see in the national numbers are actually the result of the decision of millions of individual firms, of consumers, about where to produce, what to produce, and where to sell goods to consumers. So those are the dynamics that we've looked at. And in our research, we've come up with some interesting long-term shifts that are going on and have been going on for about the last 10 years, and we think point to a very different future. So I would have to agree, I think we're at an inflection point, but for entirely different reasons than Donald Trump and trade policy. So I'll show you some slides. First, I'm going to go quickly through 6 trends reshaping global value chains. First is that the share of goods that is actually traded across borders has declined quite precipitously over the last 10 years. So between 1995, when the data starts, up through 2007, you saw that increasingly, due to the entry of China into the WTO and offshoring of production to developing countries, that more and more of what was produced was then traded. But that started to change sometime around the Great Recession and financial crisis. Now, I don't think it actually had anything to do with the financial crisis, but as it happens, around that time, the world shifted gears. And today, we consume more of what's produced within the country that it's produced rather than exporting it elsewhere. Now, this reflects 2 fundamental changes. The first is just, where are the consumers in the world? Well, a lot of them are in China, and to a lesser extent, other developing countries. So this shows you for different industries, the share of goods that China exported back in 2007. So in computer and electronics, it was exporting more than half of what it was producing. Textiles and apparels, 37%, and so on. These are the most recent figures. You can see that in each of those industries, the share of what they're exporting has gone down quite dramatically. And that's simply because Chinese consumers have more money, they're buying more goods themselves. So increasingly, what's produced in China is now sold in China. And you see the same trends going on in India, in Malaysia, Thailand, etc. So this is where global growth is going to be over the next 10 years. When we look at where are the consumers of the future, it's increasingly over there. And this explains something that is ignored in Washington, where I live, every day, which is that China's trade surplus has actually diminished very significantly over the last 10 years. So it was about 7.5% of GDP 10 years ago, and it's down to just over 1% in 2017. Now, I will be honest, a lot of that is because they have a huge services trade deficit. So they are importing services even as they're exporting goods. But exports of goods have come down a bit too. So for companies, they're at an interesting juncture in a lot of cases where increasingly what they're making in China is being sold in China. So then the question is, where do I expand capacity next? Am I going to build another factory in China? Am I going to go to a low-wage country like Vietnam or Bangladesh? Or am I going to put that production in the US or, say, Mexico close to the US? Second big trend, services trade is going through the roof. So while we see trade intensity in goods declining, services trade overall is growing 60% faster, and specific types of services trade are growing 2 to 3 times as fast. So telecom and IT services, that would include cloud computing, is growing 3 times as fast as goods trade. Business services, intellectual property charges, these things are going through the roof. So increasingly, what global trade is about, it's about services, intangible services, as opposed to shipping large quantities of physical goods back and forth. Third big trend, low wages no longer drive global trade decisions. So our image of global trade is often of companies looking for the lowest wages in the world so that they can produce manufactured goods and then send them out to the rest of the consumers in the world. But today, by our measure, that's only 18% of goods trade is from a low-wage country to a high-wage one. And here we've defined low wage and high wage. The differential has to be 5 to 1. So it's countries where GDP per capita is 1/5 the level of the importing country. That's only 18%. Now, if we define low wage and high wage a little bit differently, this number scales up and down. But the point is, it's a pretty small minority of global goods trade fits our mental model of low wage to high wage. And that's true even in the labor-intensive goods like textiles and apparel, shoes, toys, and furniture. So in those types of value chains, in 2005, over half of world trade was from a low-wage country to a high-wage one. But today, even that's changed. So only 43% is from a low wage to high wage. So why do wages no longer matter? Well, that's because of technology and automation. So even in apparel and athletic shoes and footwear, we're starting to see robotics making the products. And when you automate your production facility, then labor becomes a very, very small share of your overall cost. And so you don't need to have that factory in Bangladesh or Vietnam or Ethiopia. It could be anywhere. So then companies are looking at other factors, like, well, first of all, you need skilled labor to keep the robots working and repair them. You want a country that has low energy costs because those things suck up a lot of energy. You want good infrastructure. You want intellectual property protections. All of those factors, you may notice, favor countries like the US, particularly the energy costs. Because of fracking and the shale gas revolution, the US has extraordinarily low electricity costs. Not something you hear talked about very often, but it's a big deal in all sorts of manufacturing. As we go to the flip side of this coin is a fourth trend, which is that if low wages aren't important, what is becoming more important? And that is what we call knowledge-intensive activities. So what this chart shows you is a capitalized stock of intangible assets as a share of revenues in different industries. So back in 2000, you're looking at less than 10%. Okay, but the last 18 years have seen an explosion in investment in intangible assets like software, brands, intellectual property, operational production processes. And now, in virtually all types of industries, these knowledge-intensive activities are really where the value is being created. And that's true not just in industries that wouldn't surprise you, like computer and electronics, but you see it in chemicals, you see it even in textiles and apparel. So increasingly, companies are looking at where are the research scientists, where are the innovators, where is the startup ecosystem. And again, that favors very much the US and Europe. The fifth big trend is that while for a long period of the creation of these complex global networks of production, cross-regional trade was growing very rapidly. So this is our image of the big container ships coming from Asia, coming into ports in Long Beach and San Francisco and Seattle and so on. But since 2013, over the last 4 years, what you see is actually the fastest growth in trade corridors is within regions, not between them. This chart shows you the share of trade that happens between countries within a region as opposed to with the rest of the world. And the EU 28 is the largest share, so almost 2/3 of trade in Europe is within the EU 28. Only 1/3 is with the rest of the world. And Asia jumps out. And this is something very new because Asia, as you know, is a giant place. It's not really a region. It has very different cultures, governments, economies, and yet there has been the creation through ASEAN, but also really with the force of China, South Korea, and Japan, of supply networks and trading corridors within Asia. Over in our area of the world, over here in what I'm still calling NAFTA, I guess I'll have to call it USMCA, there's no good way to say that out loud. It's still about 41% of trade is within our region. And that share hasn't actually changed since 1995. So despite our feeling that somehow Mexico's taking up all our production, that has been quite consistent for the last 20 years. So why is regional trade on the rise? Well, it's not only the failure of the Doha round and maybe a shift from multilateralism, it's also that companies are realizing that there are a lot of costs to having these arm's length, long-distance supply chain relationships. My colleagues in our operations practice talk about the landed cost of a good. And when you add in the cost of managing that supply chain, of failures in the supply chain, and so on, you find out that sourcing a product, sometimes from very far away from a producer that you don't know, is a lot more costly than you thought if you just look at the price tag. And that when you start to compare those costs, it makes sense, especially for your tier 1 suppliers of your critical components, to actually know that supplier, to now integrate their digital systems and Internet of Things type systems so that you can track goods and production across your two companies. All of that favors having suppliers closer by. Technology is the sixth trend, and it's shaping global trade flows in complex ways. So traditionally, this whole explosion of global trade that we saw beginning in the 90s was due to ICT systems that enabled companies to start to communicate and transport goods around the world. And there's still a lot to go there. So with blockchain, with autonomous vehicles in warehouses and ports, with automated document processing, with the Internet of Things that can track shipments around the world, there's still a lot of efficiency to be gained by applying new technologies to reduce the transaction costs of trade. And in the economics literature, there's a fairly well-documented elasticity of the cost of trade. So as you bring the transaction costs down, people trade more. And we would expect this next wave of efficiency-enhancing technologies to have the same impact, and it could add, by our calculation, somewhere up to $4.5 to $5 trillion more goods trade than would have happened by 2030 without these. However, there's another whole set of technologies that could have exactly the opposite impact. So let's start with the technologies that change production processes. So artificial intelligence, automation, by which I mean smart robotics, and 3D printing technologies. I started to talk about this. So as companies adopt these technologies, you no longer need to produce based on wage costs, and instead you're looking at other things. So as these technologies roll out across different parts of the business world and manufacturing, this could actually lead to reshoring or nearshoring and reduce goods trade. So rather than having these far-flung networks, we could see the concentration of production to where the consumers are, enabling companies to get to market faster. And this could have a countervailing effect. So when you look at this, we could say we may have already reached peak world trade and it's downhill, at least as a share of what's produced from here on out. And then there's a third category of goods that I call, for lack of a better term, new goods. And these are items and new goods and services that may have some counterintuitive spill-on effects to the world trading order. So consider electric vehicles. You'd think, how is that different than trade in a regular car? Well, it turns out that there are a lot fewer components in the drivetrain of an electric vehicle than there is in an internal combustion engine. And I know I'm sitting here in Elon Musk's neighborhood, and you probably all drive Teslas, and you know this better than I do, but there are a lot fewer moving parts in those things. Turns out there's only about 15% as many moving parts in the drivetrain of an electric vehicle as opposed to a traditional car. Well, there are $750 billion of auto parts traded every year, something that Donald Trump may or may not put tariffs on. But imagine if we all move to electric vehicles, that will have a knock-on effect in trade as well. You can look at digital goods like games, movies, books, magazines, things that used to be physical goods that were traded that are now just cross-border data flows. Renewable energy is not very tradable. That could take a bite out of LNG and crude oil trade. So there's another whole set of technologies that are going to reshape production and trade as well. So what does all this mean? I'm going to leave you with just a couple thoughts. One, results from a survey that we did last September of over 1,000 business executives from companies around the world. We were asking them, what is your outlook for your global strategy? 75% said they are actively rethinking their global footprint and strategy, in part in reaction to the trade tensions and uncertainty over tariffs, and in part because of these other factors and changes in technology that I talked about. So 3/4 of companies say they are actively reconsidering. Half say that they're rethinking their geographic footprint, and they expect to change where they operate and how large their operations are in different countries around the world. Almost 1/4 say that they are investing more in domestic supply chains and vertically integrating to get around uncertainty around tariffs altogether. If anything, I mean, I'm not going to call it yet, but we may have been through an era of the disaggregation of corporations, and now there's some move towards actually bringing some of that back in-house. So companies are actively rethinking this. I think when we look at nation states and policymakers, there are a couple takeaways. One is pretty much everything I talked about favors the US and Europe and Japan. All of these trends are going to be tailwinds for doing more production in the advanced economies. Second, no matter what industry you're in, no matter which country you are, services competitiveness is very important. So in manufacturing, by our count, about 1/3 of the value of a manufactured good that's traded is actually coming from the services that go into it. And that can be upstream R&D and design. It can be the software components. It can be downstream distribution and marketing. But the line between services and manufacturing is blurring. So it's imperative both for companies to think about how can I capture value. Could talk all day about as-a-service business models that are taking off. But for countries, it's really important that services are always like the poor stepchild of manufacturing. Despite accounting for 80% of GDP, they're almost never talked about. Trade focuses on soybeans and steel parts instead of services. But that shift should focus, or that focus needs to shift. Third, this is not good news for developing countries. So a tried and true path to go from low income to high income, starting with Japan and then South Korea and Taiwan and then China, and now maybe looking at Vietnam, has been to move from agriculture into labor-intensive manufacturing and then work your way up from there. these trends, I mean, are not favorable. So what developing countries have is a lot of cheap labor, and increasingly that's not important. Now, I'm not such a pessimist that I think that that window of opportunity is over, but it's definitely closing. And what's going to be the next economic growth engine for those countries, I think is a big question mark. It has certainly not been shown that services have the productivity growth potential or the large-scale employment opportunities that manufacturing offered. So that is a worrisome question. Finally, low-income countries now have another whole set of hurdles. So I actually began my career in West Africa as a Peace Corps volunteer, and the continent is near and dear to my heart. But for those countries that didn't even get in the game in the last era of globalization, now they not only need infrastructure and ports and manufacturing and a good business climate, now they need a digital infrastructure. And they need broadband and high-speed internet at a reasonable cost. And they need a population that can actually use digital technologies. So the bar is getting higher and higher. Finally, I won't go into trade negotiations, but one of the saddest things about when the US pulled out of TPP was that we had spent literally years negotiating a digital commerce chapter and intellectual property protections. And when the other 11 countries saw that we were leaving, they said, good, we're going to scrap those things that the US foisted on us and enact CPTPP. And those things didn't get enacted. But clearly, our new trade policies, whether bilateral or multilateral, need to address the many issues around privacy, security, data flows, e-commerce, and so on. So I'm going to leave it there, and I'm going to invite Tamara Lundgren to tell us about what's happening within one company and industry.
Thank you. Well done. Thank you. So good morning, and thank you very much. Those were great presentations to follow, including the one on cannabis, which I'm not exactly sure, speaking about steel and price volatility, is going to get us to the same place. I certainly don't have as much fun getting to the bottom of that market. So I am delighted to be here today, away from the snow, in the two places where I spend most of my time, which is Portland, Oregon, and New York City. And thank you, Stanford and friends, for this opportunity to share with you my thoughts about trade and tariffs and this global steel industry. But before I begin, I'd like to tell you a little bit about the company that I'm privileged to lead. Schnitzer Steel is a company that was founded 110 years ago and went public about 26 years ago in 1993. We have 100 operating facilities across North America, and we are one of North America's largest recyclers of ferrous metal and non-ferrous metal. Ferrous metals are metals like steel that contain iron, and non-ferrous metals are metals like aluminum or copper. And in addition to recycling, we also manufacture steel products like rebar that are used in infrastructure and construction. We sell our products globally. We have a rail, barge, and trucking logistics network in the US to service our domestic customers. And we have 7 deepwater ports on both coasts of the US, Hawaii, and Puerto Rico to reach our international customers. Now, what most people don't know, excuse me, what most people don't know is that steel is the most recycled commodity in the world. More steel is recycled every year than paper, aluminum, glass, and plastic combined. In fact, the steel in your car probably came from a washing machine or from a demolished high-rise or the deconstructed Old Bay Bridge. Steel products can be recycled repeatedly without losing strength. While some form of steel has been around for hundreds, probably thousands of years, today there are 2 primary ways to make steel. One method is by using virgin materials, for example, by mining iron ore or coke, which is a byproduct of coal, and using a blast furnace. The other method is by melting down scrap metal in an electric arc furnace. This is how 2/3 of the steel manufactured in the US is made, and about 50% of the steel manufactured globally excluding China. Now, not surprisingly, using recycled steel in manufacturing saves approximately 75% in energy input, reduces water usage by 40% compared to using virgin materials. But why am I telling you all of this today? I'm telling you and describing it to you to set the stage so you may better understand the importance of the steel industry to the circular economy before we start discussing trade, Section 232, and other related topics. So steel is made in over 45 countries. The map on this slide, which shows steel production from 2007 to 2017, tells a tale of two trends. Significant growth in steel production in the emerging markets, particularly China, India, South Korea, and Turkey, and significant contraction in the developed markets, particularly the EU, the US, Canada, and Japan. During this 10-year period, China's steel production grew 70%, while total world production increased by only 25%. EU production contracted by 20%, and the US and Canada contracted by 17% and 13% respectively. Now, as all of you know, comparing percentages can be fraught with problems and result in misleading conclusions. So let's take a look at the market share change during this time period. As you can see here, in 2007, China's share of world steel production was 36%, with the EU at 16% and the US at 7%. By 2017, the change is striking. China's global share of the market increased to almost 50%. The EU, the US, and the rest of the world lost significant share. So during this 10-year period from 2007 to 2017, China essentially increased its market share from 1/3 to 1/2 of global steel production. This 10-year period, as you may recall, included the global financial crisis, the European financial crisis, and the general slowdown in China's GDP growth rate that began in 2011. Now, most economists will tell you that GDP and steel production are one of the most highly correlated relationships that exist. However, while China's internal demand for steel slowed as its growth rate slowed, production continued and actually increased, and the excess production was exported. In other words, there was simply too much steel for the Chinese to use domestically, so a significant amount of that steel ended up in the export market, and China's steel exports increased 81% between 2007 and 2015. These exports caused significant disruption around the world as excess production flooded the market at price levels that undercut countries' domestic producers, costing customers jobs and profitability. So producers around the world faced with lost market share and significant price suppression turned to the only real tool available to them, which was to file unfair trade cases. These trade cases are based on principles established by the WTO and its predecessors, which recognize that certain types of trade practices are unfair. And these unfair practices include both dumping, which means selling at less than fair value or selling below cost, or receiving unreasonable government subsidies. The chart on the left shows the distribution by product of anti-dumping cases filed by producers all over the world between 1995 and 2013. And as you can see, metals represent more than 1/4 of these cases. And by 2014, metals as a share of the total had increased to about 1/3. And over the following 2 years, as you can see from the chart on the right, metals anti-dumping cases had increased to almost half. And China was the largest target of all anti-dumping cases filed by countries over this broader period. Now, many of these cases were successful, which meant that various governments, after an investigation, concluded that imports had been dumped or had been unfairly subsidized and that domestic producers had been injured. Consequently, tariffs were imposed and imports declined from the countries named in those cases. But trade cases are blunt instruments, and even with tariffs in place, steel producers who had been injured by dumping and unfair subsidies were not out of the woods for a number of reasons. First, while tariffs do result in slowing imports of the products that have been dumped or subsidized, those tariffs go to governments. The producers do not receive compensatory damages. Second, each case is specific to a product and specific to a country, and as a result, it's a bit like whack-a-mole. Chinese exports may slow, for example, but China may sell those unfairly priced goods to another country that then transships or exports at those unfairly priced levels. Now, to counter that, a new case must be filed against that country. And third, the products can be altered slightly to avoid the tariff. But the biggest issue is that in order to succeed in a case, you have to prove you've been injured. Thus, by the time you file, and the filing process is slow and expensive, plants are idled, jobs are eliminated, and market share is lost. So, what happened with the flurry of trade cases against China that were filed and resolved in favor of various domestic producers? And these are not just US domestic producers, but producers in the EU and Canada and elsewhere. As you can see from this slide, Chinese exports began declining. And certainly trade cases were one reason, but there were likely other reasons as well. There was WTO pressure on China to rein in production and exports. China had wanted to be taken off the WTO's list of non-market economies, but partly due to the steel situation, the EU and the US would not agree. Also, Chinese government policy became much more focused on environmental issues and pollution, and China began closing older, less efficient, and highly polluting mills, thereby reducing their production capacity. China produces only about 10% of their steel using recycled metals. 90% of their steel is made using iron ore. Finally, pressure came from the Chinese state-owned banks that were holding underperforming loans that had been made to Chinese steel producers, and these factors all contributed to the decrease in both Chinese exports and capacity. So this leads us to the widely discussed Section 232 action. What is Section 232? As you heard from Al, it is a provision of US law, again modeled on global rules, that allows for action if there is a determination that imports have entered in such quantities or under such circumstances as to threaten to impair the national security. Now, there's been a lot of debate about whether the use of Section 232 was appropriate in the case of the steel industry. Arguably, a country as diverse and as large as ours should have a healthy steel industry. But I'll leave that debate for another day, or unless you want to bring it up in the Q&A. But there is no doubt that the level of imports and the extreme level of dumping was proving an existential threat to the US steel industry, as well as to other countries as well, like the EU or regions. The administration, consequently under Section 232, imposed 25% tariffs, and you have seen other countries follow that suit. Now, a few countries were exempted at the beginning, including our close allies, Canada and Mexico. The hope was that this would mark a paradigm shift and that these exempted countries and even others would agree to voluntary import reductions. Some countries have reached agreement with the US, including Australia, which agreed to export monitoring, and South Korea, Brazil, and Argentina, which have agreed to quotas. The impact of Section 232 and the tariffs applied thereunder was a further slowing of steel imports, and that, together with a stronger US economy, have contributed to the current recovery that we're seeing in the steel industry. And we can see in this chart that shows the improving trend of average US steel capacity utilization over the last 10 months. US steel mills have historically demonstrated sustainable profitability at utilization rates at about 80%. Average US weekly capacity utilization rates for 2018 were approximately 78%, and last week reached almost 83%, the highest level seen in the US since 2008. But clearly, a situation where each country imposes across-the-board tariffs is neither optimal nor sustainable, so we need to look for a better solution. So what is that solution? Well, there's not just one answer, as problems as complex as this require a range of alternatives. First, we do expect a transition from flat tariffs to more creative approaches to global imbalances, as we are already seeing with Australia, South Korea, Brazil, and Argentina. Second, we need more dynamic trade agreements, and these can include enhanced enforcement if the agreement is violated without the need of WTO action or other review. And these are the types of mechanisms that we're reading about in the paper with respect to the ongoing Chinese-US negotiations. And the USMCA also has similar robust provisions. Finally, global problems require global solutions. And this means we need to work bilaterally as well as regionally, but we also must work globally. And that brings me to the last bullet point on this slide, to modernize the WTO. The WTO system has been transformational in providing a superstructure for world trade. But similar to my discussion on trade actions, the WTO is not equipped to handle massive disruptive events or the speed of change in today's global economy. Enforcement is also very difficult and quite cumbersome. Even the one tool in the producer's toolkit, the unfair trade actions, are neither nimble nor broad enough. All of this shows that the WTO must be part of the solution, and the US must play a leadership role. We cannot sit on the sidelines. So hopefully this has provided some perspective on the tariff situation and the steel industry, and I look forward to our discussion and your questions. Thank you.
Thank you. So we have about a little less than 12 minutes. I want to ask a few questions of the panelists, and if we have a few minutes left, we can open it up. But let me just start to all three of you. You actually, all three, have a slightly different perspective on what's going on in the world economy today. So the question I want to ask you is, how fragile do you think the institutions are? Tamara just talked about the WTO needing to be reformed. Al told us that the US has undermined the WTO, and everything that we have done in terms of dumping and 232s is against the fundamental rule system. And Susan has helped us to see the fact that actually business is sort of living in an environment where they're worrying about trade, but pretty much going on like business as usual. So should we be worried? You know, are you three talking to each other, talking against each other? Do you see the same world? And so let me just ask you to react almost to each other's perspectives, which if you look closely at them, we're really not on the same page.
So I actually think that we're all very much aligned.
Okay.
I actually do, because I think Al and I completely agree that the WTO needs to be reformed. And I actually think if you read what Celeste Malmstrom, who is the president of the EU, I can't remember what is her?
Trade Minister.
Trade Minister of the EU, thank you. And she and Ambassador Lighthizer both agree that the WTO's judicial activism needs to be reined in, and it does need to be addressed. And they just, I mean, that was just, their interview just came out yesterday. So I think that you almost have to break the egg to get it fixed, particularly for these very large institutions that have 164 members. Then I'd also say that we're seeing the same issues if you look at trade, where there is a significant leaning toward bilateral and regional agreements, as opposed to much more comprehensive, because they are more dynamic. They reflect current situations and can move as countries move from developing to developed. The trade agreements need to move with them. Otherwise, you do end up with terrible imbalances, because you've got developed trading with developed, but one of those has the benefit of developing support. So
Okay,
I think we're quite aligned.
But if you advocate that the steel industry maybe is in an existential crisis and the 232s are perhaps maybe legitimate, the 232s fly in the face of almost every part of the GATT-WTO system in which we would not expect countries to use this kind of unilateralism. How do we reform a system if we're throwing darts at it? That's just my response. I don't have an answer, but it's a very different way of thinking about it. Those 232s are in no way consistent with what the GATT-WTO has stood for since 1947. Susan, go ahead, yes.
Yeah. Clearly policy matters. We call it free trade, but I think as Al has demonstrated, it's never been free. It is extremely regulated. It is filled with lawyers. And there are companies that design their products, like Columbia Sportswear does design for tariff. So if you add a piece of whatever, a flannel on a legging, then it's a pair of sweatpants, not leggings. And I mean, they literally design their products to minimize tariffs. So I don't want to say that tariffs don't matter in policy. It doesn't matter, but I'm sure we all agree that the WTO needs a major overhaul.
Yeah. What do you think, Al? Inflection point?
Well, the problem is, as I mentioned, to change anything, you need everybody to agree in this enormously dense system. We need China, the EU, the United States, the Canadians, the Japanese. They all have to agree to make any sort of changes in the dispute system or anything else. And it's hard to be optimistic that we're going to be able to come to agreement on that. So I think the view of the Obama administration that favored kind of letting the WTO sit in the background and do its thing, but try to make progress through the mega regional approach, to me, kind of makes the most sense, maybe.
So, Susan, in your survey of businesses, it's very clear that they're worrying about the Trump administration and uncertainty, the uncertain environment in which they're doing business. I mean, how important is that these days in thinking about where they're going to invest? Are people pulling out of China? Are people thinking that, you know, we have to worry about we don't know where voluntary restraints are going to come, if that's where we're leading to? I mean, what percentage of this uncertainty, how is this translating into business activity?
Yeah, it is. It's one of many factors. So I think Al mentioned the latest U.S. trade numbers in which we saw a record trade deficit. And honestly, our research would say we should have expected that because the goods that we put tariffs on were parts of supply chains, and those take time to switch. That takes a capital investment, billions of dollars. So if you're importing auto parts, you're going to continue to do it, whether there's a 10% tariff or a 25% tariff for a number of years. And the things that China, for instance, countered on were the things like soybeans that are very easy to say, tomorrow I'm not going to buy your soybeans, I'm going to buy them from Brazil. And that's exactly what explained, you know, the blow up of the trade deficit. But look, I think it's one of many factors, but it's going to take time. So yes, there's some shifting of decks, chairs on the deck of the Titanic for sure, like, okay, we're going to, you know, export to China from Vietnam instead of directly from the U.S. But over time, as companies decide where am I going to invest in new capacity, that's where I think that a lot of companies are realizing that just the ongoing uncertainty and now, you know, how long will these policies go on? How long will Trump be in office? The Democrats, who will be the Democratic candidate, when they come in, what is their view going to be? I mean, there's no end to the uncertainty, at least in the U.S.
Democrats might not be any better. I'm going to ask one last question, Al, and I just know this from your background. Tamara talked in a slightly positive way about anti-dumping duties against steel. I know this is one of your issues. What do you think about Tamara's response that actually maybe these were legitimate and anti-dumping is a positive part of U.S. trade policy?
Well, so it's an unfair trade statute, right? And who am I to say what's fair or unfair? I don't purport to be the arbiter of fairness. The objection that economists have always had to anti-dumping, the law was presented as an adjunct to antitrust, to stop monopolization of industries. And what's missing from the way anti-dumping is conducted is any kind of structural analysis to see whether there's any danger of actual monopolization. And so in a world where, as you say, 45 countries produce steel, you know, is there a competition policy concern there? And if not, economists tend to be a bit skeptical about the anti-dumping exercise, but you can defend it on fairness grounds, and who am I to say that that's not persuasive?
Fairness, and if you saw the market share, if it had continued, most of those countries would have shut down their steel industries.
Fair enough.
We maybe have one, let's take one question from the audience. I'm sorry, we've gone a little bit long. We have two, okay. Why don't do we have someone, any hands? Yeah, go ahead, yeah.
Paul Krugman's thesis basically disputed the entire structure of the analyses presented, all three of them, which are basically David Ricardo factor analysis, cost analysis, in favor of what was supposed to be a new spiffy version of the home market effect as juiced up by imperfect competition and home market market power. And yet and that is supposed to particularly dominate in regional trade groups, which we have been told now are growing in significance. Yet nobody even mentions it, even though we have three different perspectives. Any reason for that?
Okay, home market, what do you think? Go ahead, Alan.
So I take it,
Yeah.
I take it you're sort of focused on the agglomeration economies, the proliferation of product varieties from industrial policy, some of the early.
No, the theory was that if you have market power at home, then in an imperfect market structure, you will export. This was presented by Krugman as explaining all global trade, which was supposedly not driven by factor analysis. Then it broke down when a guy at Columbia blew it up and showed there were analytic problems, and he reconstructed it as a new economic geography, which supposedly completely explains regional trade structure, even though nobody in Europe was talking about it when the French rejected the EU Constitution. Now I'm just wondering, Larry Summers' early career was supposedly determined largely by his showing that this was the dominant effect in major countries around the world, and yet I don't hear anything about it. I was just curious.
Well, from my background, it does connect back to the industrial policy idea, and the idea that you can grow comparative advantage by taking advantage of economies of scale in an industry and building it up locally with all sorts of economies of scale and maybe intellectual property spillovers, the Silicon Valley story, and so forth. So yeah, I think that's a real part of the landscape. No, I think that's a part of the explanation for the patterns of who produces what. I think that's an interesting contribution to the field.
Yeah, let me add to
Go
that.
ahead, Susan. Yeah.
I think that one of the things that it's missing, though, is the concept of value chains, that it's very much focused on finished goods, but a lot of the increase in trade that we've seen is not a dominant producer expanding abroad. It's the disaggregation of the firm into offshored component parts, and I think it missed that. The other thing I think it missed is the role of the state. So imperfect competition in terms of companies that have access to very cheap credit, below cost of capital, and other things. And this is what, we see day to day. So if you're a US or European company and you're competing against a Chinese company that may or may not pay dividends, has a very different corporate tax rate, it's very cheap access to capital, it's really hard to compete against that. So it says nothing about whether one is a superior business model to the other or more productive, but it's just hard to compete.
Okay, with that, we should probably wrap up, so please join me, everyone, in thanking Judy, Susan, Tamara, and Al.